Picture this. March 19th, 2024, the Bank of Japan makes an announcement that shakes global markets after 17 years of keeping interest rates at zero, after printing more money than any developed nation in history, after buying so many bonds that they own 53% of their own government's debt. They raise rates, not by much, just 0.8%, from negative 0.1% to positive 0.1%, a microscopic increase within 72 hours. The Japanese yen strengthens 3.8% against the dollar. Carry trades worth an estimated $4 trillion start unwinding. The Nikkei falls 7.2% in a week. US tech stocks drop 4.3% as Japanese investors repatriate capital. And that was just a 0.1% rate hike. Now it's January 2026. The Bank of Japan just raised rates again to 0.75%. And this time, something different is happening. Japan's debt-to-GDP ratio stands at 264%. That's 10.5 trillion in debt, the highest of any developed nation in history, and the interest costs are starting to matter. Here's the paradox that should terrify every American investor. Japan has been the warning system for global debt crises for 30 years. When Japan's bubble burst in 1990, it predicted the 2000 dot-com crash. When Japan entered deflation in the late 1990s, it predicted the 2008 financial crisis playbook. And now, Japan's debt bomb is finally detonating, which means the US, with its 36.5 trillion in debt and 123%, debt-to-GDP ratio, is watching its future unfold in real time. Before we dive into why Japan's debt crisis is the clearest warning signal for American investors since 2007, and why your portfolio is more exposed than you think, hit that subscribe button and join the Wealth Forum. This is the sovereign debt endgame playing out in the world's third largest economy, and it's coming to America next. It's free, unlike the price you'll pay for ignoring this warning. So here's the question that changes everything. If Japan, with a 264% debt-to-GDP ratio and decades of experience managing debt crises, is finally breaking, what happens to the US when rates rise and debt service costs explode? Stick with me. Let me show you the historical pattern that makes Japan's crisis so important. Japan has been the laboratory for every monetary experiment the world has tried for the past 35 years. 1990, Japan's asset bubble bursts. Real estate values that had made Tokyo theoretically worth more than all of California collapsed 87% over the next decade. The Nikkei fell from 38,915 to 7,054, an 82% crash over 13 years. The Bank of Japan's response? Cut rates to zero. Print money. Buy government bonds. The exact playbook the Federal Reserve would use 18 years later during the 2008 crisis. Japan pioneered quantitative easing. They invented zero interest rate policy. They showed the world how to fight deflation with unlimited money printing. But here's what happened. The debt didn't go away, it grew. In 1990, Japan's debt to GDP was 67%. Today it's 264%. They printed money to service the debt, which required more borrowing, which required more money printing. It's the ultimate debt spiral. And for 30 years, they got away with it. How? Because interest rates stayed at zero. When you owe 10.5 trillion but pay 0% interest, the debt is manageable. It's still there, growing, but the annual carrying cost is minimal. Here's the analogy that explains this perfectly. Imagine you have a $500,000 mortgage at 0% interest. You only have to pay the principal, and even that you can defer. Manageable, right? Now imagine rates go to 3%. Suddenly you're paying $15,000 per year in interest alone. Then rates go to 5%. Now it's $25,000 per year. The same debt becomes unsustainable when rates rise. That's exactly what's happening to Japan right now. For 17 years, rates were effectively zero. Japan's government paid almost nothing to service, 10.5 trillion in debt. But in March 2024, rates went from negative 0.1% to positive 0.1%, then to 0.25% by July 2024, then to 0.5% by March 2025. Now 0.75% by January 2026. Still low by historical standards, right? But here's the math that doesn't work. At 0% rates, Japan pays roughly 80 billion per year in debt service. At 1% rates, they'd pay 105 billion. At 2%, which is the Bank of Japan's inflation target, they'd pay 210 billion. That's $130 billion more annually, just from rate increases. Japan's total government revenue is approximately $1.7 trillion. If debt service costs rise by $130 billion, that's 7.6% of all revenue going just to higher interest payments. That's before paying for defense, healthcare, pensions, infrastructure, just interest. And here's where it gets worse. Japan's population is aging rapidly. By 2050, 38% of Japanese will be over 65. That means fewer workers paying taxes and more retirees, drawing pensions and healthcare. Revenue declining while costs rising. It's a demographic and fiscal time bomb. The pattern is clear. Japan showed us what happens when bubbles burst. Now they're showing us what happens when debt spirals hit the endgame. And the US is following the exact same path, just 30 years behind. Let me explain exactly how Japan's debt bomb explodes and why it matters for American investors. Mechanism 1. The sovereign debt doom loop. Japan's government borrows money by issuing bonds. Those bonds must be bought by someone. Historically, Japanese citizens bought them. Japan has a high savings rate, and Japanese banks and pension funds invested those savings in government bonds. It was a closed loop, but as the population ages and retires, savings rates are falling. Retirees sell bonds to fund retirement. Who buys them? Increasingly, the Bank of Japan. They've been buying government bonds directly for 15 years. They now own 53% of all Japanese government bonds. That's 5.6 trillion worth. This creates the doom loop. The government issues debt. No private buyers exist at these low rates, so the central bank prints money and buys the debt. This increases the money supply, causing inflation. Inflation forces the central bank to raise rates to maintain credibility. Higher rates make the debt more expensive. The government must issue more debt to pay the higher interest. The cycle repeats. At some point, confidence breaks. Investors realize the debt can never be repaid. They dump bonds. Yields spike. The government can't refinance at the new higher rates. Default becomes inevitable. Mechanism 2. The yen carry trade unwind. For decades, investors borrowed yen at near zero rates, converted it to dollars or euros, and invested in higher yielding assets globally. This trade was enormous, estimated at $4 to $5 trillion globally. When the Bank of Japan raised rates in March 2024, even by 0.1%, the carry trade started unwinding. Investors had to repay yen loans. That meant selling dollar assets and buying yen. That selling pressure on dollar assets contributed to the market volatility. Now, with rates at 0.75%, the unwind is accelerating. Every rate hike makes the carry trade less profitable. Eventually, it becomes unprofitable. At that point, all $4 to $5 trillion starts unwinding simultaneously. That's $4–5 trillion in selling pressure on global assets, including US stocks and bonds. Mechanism 3. Japanese investor repatriation. Japanese institutions, primarily pension funds and insurance companies, own approximately $4.3 trillion in foreign assets. About $1.3 trillion of that is in US assets. Treasuries, stocks, real estate. When Japanese interest rates were zero, these institutions invested abroad to get any yield. US Treasuries paying 4% looked attractive compared to Japanese. Bonds paying 0%. But as Japanese rates rise, the calculation changes. If Japanese government bonds start paying 1.5%, 2%, eventually 3%, why take the currency risk and geopolitical risk of investing in the US? Japanese institutions will repatriate capital. $1.3 trillion in US assets owned by Japanese investors. If even 30% repatriates over 2 years, that's $390 billion in selling pressure on US Treasuries and stocks. That pushes US yields higher, which crashes bond prices and hurts stocks. Mechanism 4. The inflation debt spiral. Japan has fought deflation for 30 years. Now they finally have inflation, 2.5% as of January 2026. The Bank of Japan's target is 2%, so they've overshot slightly. Normally, central banks raise rates to bring inflation down, but Japan can't, not aggressively, because higher rates make the debt unsustainable. So they're trapped. Accept inflation above target, or raise rates and trigger a debt crisis. They're choosing inflation, but inflation erodes bond values. If you own a Japanese government bond paying 0.75% and inflation is 2.5%, your real return is negative 1.75%. Why would anyone accept that? They won't. Bondholders will demand higher yields to compensate for inflation. That forces yields up, which forces debt service costs up, which requires more borrowing, which creates more inflation. Spiral. Mechanism 5. Credit rating and risk premium. As of January 2026, Japan's sovereign credit rating is A+ from S&P and Fitch, AA2 from Moody's. Still investment grade, but the outlook is negative. If Japan's debt dynamics continue to deteriorate, ratings agencies will downgrade. Once you lose AA status, institutional investors with mandates to only hold AA or higher must sell. That creates forced selling, pushing yields higher, making the debt problem worse. Additionally, as the risk of Japanese default increases, investors demand a higher risk premium. Japanese bonds currently yield about 0.75%. If investors start demanding 1%, 1.5%, 2% to compensate for default risk, the debt becomes immediately unsustainable. These 5 mechanisms are all interconnected. They feed on each other. The doom loop triggers carry trade unwinds, which triggers repatriation, which triggers inflation spirals, which triggers downgrades and risk premium increases. It's not one explosion, it's a chain reaction. And every single mechanism applies to the United States, with a 30-year lag. Now let me show you the exact moment Japan's debt bomb started, its final countdown, and why. American investors should be terrified. December 19th, 2024, the Bank of Japan holds a policy meeting. Markets expect them to hold rates at 0.5%. Instead, they raise to 0.65%. A hawkish surprise. The yen strengthens 2.1% in one day. Japanese bonds sell off. Yields jump 12 basis points. The Nikkei falls 3.4%. But more importantly, something breaks in the Japanese bond market. For the first time in 15 years, the Bank of Japan cannot control the yield curve. They're supposed to control 10-year yields through unlimited bond buying. But on December 19th, even with 60 billion on emergency bond purchases, they can't keep yields below their target. The market is stronger than the central bank. That's the first crack. January 15th, 2025, Japan's Ministry of Finance releases the annual budget. Debt service costs are projected at 210 billion for fiscal year 2025, up from 180 billion in 2024. That's a 16.7% increase in 1 year. The increase alone is larger than Japan's entire defense budget. The ministry quietly projects that if rates rise to 1.5%, debt service would consume 18% of all government revenue. At 2%, it would be 24%. These aren't hypothetical scenarios. These are internal government projections leaked to the press. March 2025, the Bank of Japan raises rates again to 0.75%. This time, the justification is clear. Inflation is 2.8%, well above target. Wage growth is 4.1%, the highest in 30 years. They have to raise rates to maintain credibility. But the market reaction is violent. The yen surges 4.2% in a week. Exporters get crushed. Toyota, Sony, Nintendo all see their stock prices fall 8 to 12% as yen strength destroys their competitiveness. The Nikkei falls 9.3% in March 2025. Then comes the revelation. April 2025, a major Japanese pension fund, the Government Pension Investment Fund, the largest pension fund in the world with $1.7 trillion in assets, announces it's reducing foreign asset exposure from 50% to 35% over 3 years. That's a $255 billion reduction. And it's not just happening. $85 billion per year for 3 years. Most of that will come from US assets, Treasuries and stocks. They're bringing the money home because Japanese yields are finally high, enough to justify it. The announcement triggers a 1.8% drop in the S&P 500 over 2 days. US Treasury yields jump 8 basis points. The market realizes Japanese repatriation is beginning. And this is just one fund. There are dozens of Japanese institutions with trillions in foreign assets. June 2025, Moody's puts Japan's credit rating on review for downgrade. The reasoning is blunt. Debt trajectory unsustainable. Interest rate normalization incompatible with fiscal position. Structural reforms insufficient. The review doesn't lead to an immediate downgrade, but the warning is clear. Japan is on a path to losing its AA rating. When that happens, institutional selling will accelerate. August 2025, the Bank of Japan faces a decision. Inflation is at 3.1%. Their mandate requires them to raise rates. But Japanese bond yields are at 1.2%, the highest in 14 years. Debt service costs are projected to hit $240 billion annually if they raise rates further. They choose to pause rate hikes. Inflation over debt sustainability, but this destroys their credibility. If the central bank won't fight inflation to protect the government's finances, the currency is doomed. The yen falls 6.8%, in August 2025, from 138 per dollar to 147. That's a massive move for a major currency in 1 month. Japanese citizens start hoarding dollars, gold, foreign assets. Capital flight begins. October 2025, Standard and Poor's downgrades Japan from A+ to A, the first downgrade in 12 years. The justification cites deteriorating fiscal flexibility and rising debt service burden limiting policy options. The downgrade triggers automatic selling from certain institutional mandates. Japanese bond yields jump to 1.5%. The government must now refinance maturing debt at 1.5% instead of the 0.5% they paid 3 years ago. Debt service costs are exploding in real time. December 2025, the Bank of Japan is forced to resume rate hikes. Inflation is 3.4%. The yen has weakened to 152 per dollar. Imported inflation is spiraling. They raise rates to 1%. But here's the problem. At 1% rates on 10.5 trillion in debt, annual interest costs are $105 billion. Add in the old debt still carrying higher rates from decades ago, and total debt service is now $270 billion, or 15.9% of government revenue. Japan is spending nearly 1/6 of all tax revenue just on interest payments. And rates are only at 1%. If they go to 2%, which inflation suggests they must, debt service becomes $350 billion, or 20.6% of revenue. That's unsustainable. The government cannot spend 20% of revenue on interest, while also funding pensions, healthcare, defense, and infrastructure for an aging population. January 28, 2026, the moment of revelation. Japan's Ministry of Finance announces it will issue $890 billion in new bonds in fiscal year 2026. That's a 14% increase from 2025. Of that, $340 billion is just to pay interest on existing debt. They're borrowing to pay interest on borrowing. The market realizes the endgame has begun. This is the debt spiral's final stage. When you borrow to pay interest, and those interest costs are rising due to rate hikes, you're in an exponential doom loop. Japanese bonds sell off hard. The 10-year yield hits 1.8%, the highest since 2009. The Nikkei falls 11.2%. In January 2026, the yen weakens to 155 per dollar as capital flight accelerates. And then the connection to the US becomes undeniable. US Treasury yields jump 14 basis points in sympathy. The S&P 500 falls 3.7% in a week. American investors are starting to realize Japan's debt crisis isn't just a Japanese problem. It's a preview of the American crisis coming. Now let me show you exactly how Japan's debt bomb explosion hits American investors. US Treasury market loses its largest foreign buyer. Japan is the largest foreign holder of US Treasuries, owning $1.1 trillion as of January 2026. As Japanese institutions repatriate capital, they sell treasuries. If Japan reduces holdings by just 20% over 2 years, that's $220 billion in selling pressure. Who buys those treasuries? Either the Federal Reserve, which means money printing and inflation, or private investors, but only at higher yields. Higher yields mean lower bond prices. If you own treasury bonds or bond funds, you lose money. Higher yields also mean higher borrowing costs for the US government, increasing deficits, creating a similar doom loop. Yen carry trade unwind crashes risk assets. The 4 to 5 trillion yen carry trade has been a major source of liquidity for global risk assets. As it unwinds, that liquidity disappears. Hedge funds, private equity, venture capital, all leveraged with cheap yen borrowing, must deleverage. That means selling stocks, bonds, real estate, crypto, everything. The correlation across asset classes goes to 0.9 plus. Everything crashes together. We saw a preview in August 2024 when a small rate hike caused a brief carry trade panic. The VIX spiked to 65. The S&P 500 fell 8% in 3 days. That was a warning shot. The full unwind will be 10 times worse. Japanese corporate repatriation hits US stocks. Japanese corporations own significant stakes in US companies. Toyota, Sony, SoftBank all have major US investments. As the yen weakens and Japanese rates rise, they'll repatriate capital. SoftBank alone has $140 billion in assets, much in US tech companies. If they sell even 30%, that's $42 billion in selling pressure on specific stocks. Multiply this across hundreds of Japanese corporations, and you're looking at hundreds of billions in potential selling. Inflation transmission through yen weakness. When the yen weakens from 138 to 155 per dollar, Japanese imports become 12% more expensive. Japan imports oil, food, raw materials, all priced in dollars, all suddenly 12% more expensive. Japanese companies pass those costs to consumers. Inflation rises. The Bank of Japan must raise rates further. That weakens the economy, reducing demand for imports, including from the US. But it also means Japanese exporters become more competitive. A weaker yen makes Toyota, Sony, Nintendo cheaper globally. That takes market share from US companies. Apple, Tesla, GM all lose sales to Japanese competitors. The demonstration effect for US debt. This is the big one. Japan's crisis demonstrates that high debt to GDP ratios are only sustainable at zero rates. Once rates rise, the debt becomes unmanageable. The US has a 123% debt to GDP ratio, still lower than Japan's 264%, but rising fast. US debt increased $2.3 trillion in 2024 alone. At current rates of 4.5%, debt service costs are $1.2 trillion annually, or 17% of revenue. Japan is showing what happens when rates normalize on a high debt load. Investors are watching. If Japan's debt spiral leads to default, devaluation, or financial repression, markets will price that risk into US assets. Treasury yields will rise as investors demand compensation for default risk. The dollar will weaken as confidence erodes. Inflation will rise from currency debasement. The US will face the same doom loop Japan is in now. Risk-off sentiment crushes equities. As Japan's crisis unfolds, global risk appetite declines. Investors move from stocks to cash, from risk assets to safe havens. But with Japanese bonds no longer safe, and US Treasuries increasingly questionable, where's the safe haven? Gold surged to 5,200 in January 2026, partly due to Japan crisis fears. Swiss francs, Bitcoin hit DARP 112,000. These aren't fundamentals. These are panic flows. When the panic subsides and these assets correct, investors face losses everywhere. Your stocks down from risk-off, your bonds down from rising yields, your safe havens down from panic unwinding. There's no place to hide. Pension and insurance company failures. Japanese pension funds and insurance companies are massively exposed to Japanese government bonds. When bond prices fall 20–30% due to rising yields, these institutions face insolvency. If major Japanese financial institutions fail, contagion spreads. Credit markets freeze. Global banks with exposure to Japanese counterparties face losses. We're looking at a potential 2008-style credit crisis, but originating from sovereign debt instead of housing. Consequence 8. The policy response makes it worse. When Japan's debt crisis accelerates, they'll try desperate measures. Capital controls to prevent outflows. Currency intervention to support the yen. Yield curve control to cap bond yields. All of these measures destroy confidence further. Capital controls signal desperation. Currency intervention burns through foreign reserves. Yield curve control requires unlimited money printing, causing inflation. Each attempted solution creates new problems. The crisis escalates, and markets watch, knowing the US will face identical choices when its turn comes. So here's the brutal truth that every American investor needs to understand. Japan's debt bomb isn't just exploding. It's showing the entire world what happens when decades of money printing, zero interest rates, and unlimited deficit spending finally hit the endgame. For 30 years, Japan has been the laboratory. They showed us QE. They showed us zero rates. They showed us how to fight deflation. Now they're showing us how it all ends. And the lesson is clear. You can only sustain massive debt at zero interest rates. Once rates normalize, even slightly, the math doesn't work. Debt service costs explode. The government must choose between defaulting, inflating, or imposing financial repression on its citizens. Japan is choosing inflation and financial repression. They're keeping rates artificially low despite inflation above target. They're forcing Japanese citizens to accept negative real returns on savings. They're devaluing the currency to make the debt burden lighter in real terms. This is the endgame playbook. And the United States is holding the same playbook, ready to use when its crisis begins. The US has $36.5 trillion in debt. Debt to GDP of 123%. Annual deficits of $2+ trillion. Debt service costs of $1.2 trillion annually at 4.5%. Average rates. If rates rise to 6%, debt service hits $2.2 trillion. That's 32% of all federal revenue. The math doesn't work. Just like Japan, the US will face the choice. Default, inflate or repress. Default is politically impossible. That leaves inflation or repression. Inflation means the Federal Reserve keeps rates below inflation, allowing dollars to lose purchasing power. reducing the real value of debt. Your savings, your bonds, your fixed income all lose value silently. Financial repression means forcing institutions to buy government, bonds at artificially low rates, pension funds, insurance companies, banks, all required to hold treasuries paying 3%, while inflation runs at 5%. They lose money, so do you. This is the future Japan is showing us, and American investors need to position accordingly. What does that mean practically? First, understand that traditional 60-40 portfolios will be destroyed. Bonds will lose value from rising yields, or get destroyed by inflation if yields are artificially suppressed. Stocks will struggle as economic growth slows under the debt burden. Second, own hard assets. Gold isn't just a hedge, it's insurance against the debasement that's coming. At $5,200 and rising, gold is pricing in exactly this scenario. Third, own assets outside the dollar-denominated system. International stocks in countries with lower debt loads. Real estate in politically stable jurisdictions. Currencies backed by commodities or fiscal discipline. Fourth, own businesses with pricing power. Companies that can pass inflation to customers will survive. Companies on thin margins will be destroyed. Fifth, prepare for volatility. The transition from the current system to whatever comes next will be chaotic. Sharp moves in currencies, bonds, stocks, commodities. Correlation across assets at extreme levels. Traditional diversification failing. The Japan crisis is the warning. The US crisis is the destination. The question isn't if, but when. And the answer is probably sooner than most people think. Japan held rates at zero for 17 years before they had to raise them. The US held rates at zero for 7 years after 2008. They raised them in 2022, but by 2024 they were already cutting again. The US doesn't have Japan's discipline or patience. When the US debt crisis begins, it will move faster than Japan's. The dollar's reserve currency status is both a blessing and a curse. It allowed the US to accumulate more debt than any nation in history. But when confidence breaks, the fall will be harder and faster. Japan's debt bomb is exploding in slow motion. We're watching the first stages, the yen-carry trade unwinding, repatriation beginning, yields rising, debt service costs becoming unsustainable. The full detonation hasn't happened yet. But it's coming, and when it does, the shrapnel will hit every American portfolio. If this analysis showed you why, Japan's debt crisis is the most important warning signal for US investors right now. Smash that like button, subscribe to the Wealth Forum, and turn on notifications so you understand every stage of this sovereign debt crisis as it unfolds globally. Now here's my question for you. What percentage of your portfolio is positioned for a Japan-style debt crisis in the US? Drop your number in the comments. Are you 100% traditional stocks and bonds? Or have you hedged with gold, international assets, and inflation-protected securities? Tell me if you think the US will avoid Japan's fate, or if we're on the same path just 30 years behind. Do you own Japanese assets? And if so, are you reducing exposure? I read every single comment. This community is preparing together.